Welcome to Boutiques Connect with Flagship Asset Management. I'm Joanne Baynham, and today I'm joined by James Hayward, Fund Manager, Flagship Asset Management. Welcome.
Hi, Joanne.
I looked at the numbers for the Worldwide Flexible Fund, and the performance has definitely improved of late. And I see coincidentally you've also joined quite recently. When did you join Flagship, and tell me more about that?
So I joined Flagship at the beginning of 2021 actually. I joined as a global equity analyst. I think one of the benefits of joining a boutique is that you get a lot of exposure to portfolio management quite quickly. So that was the case. And then in about July last year I started managing the Worldwide Flexible Fund along with Philip Short.
Okay, and so I look at the numbers, and as I said earlier, they're definitely improving. What have you two done differently? What has there been a change to the process? I mean, it's very short term, I'm understanding that, but have you made changes the way the fund used to be run?
Yes, we've definitely made some changes. I think most of them you could boil down to an enhanced risk management system. And so how we're doing that is we've increased the number of holdings in the fund. So it's still quite concentrated. It used to be about 25, currently sitting at about 35, but we'll probably take that up to 40, between 40 and 45. We've started taking into account some quantitative factors as well, just to give us a better idea of when to or how to time our entries and exits. And what we try and achieve by that is really to let our winners run and cut our losers. So quite often it happens in the investment industry, I think, that people cut their flowers and water their weeds, and we try to very much steer clear of that. And I think, if you've got set methods almost or guidelines of when to exit a position, if it's not working out for you, you can take a step back and find better opportunities.
I guess it also takes a lot of mental energy away from you if you can continually seeing a stock falling.
It's
not good for your soul. So I totally understand that. Within the portfolio itself, are there any kind of themes that you're currently overweight? My feeling is you're underweight tech. Did I get that wrong? Or?
No, so you'd be correct on that. So let's talk about the overweight side first. So we're quite overweight defensive stocks at the moment, actually. So we're playing that theme through Rheinmetall, Rolls-Royce, and Hensoldt. Rheinmetall and Hensoldt, both German defense companies, and then Rolls-Royce, obviously commercial aerospace mostly, but also a defense angle on that. And I mean, we can go into the reasons for that if you like, but there's been structural underinvestment in defense in Europe for the better part of 2 decades probably. And this has been very much exposed, with recent events in Ukraine, with Donald Trump coming to the table saying, you guys need to pay up. And we've definitely started seeing that people are paying up. So a lot of room to grow there, we believe. And then from an underweight side, it might look optically like we are very much underweight tech, but some nuances there. So something like Amazon, for example, which would go through as consumer discretionary, but a large part of the business is actually driven by tech.
Just going back to tech for a second, companies like Apple have been underperforming for a couple of months now, and then you've also got the story around Alphabet / Google also struggling. Are those 2 tech positions you hold, and if so, why?
We don't hold any of those. So of the Magnificent 7, we currently only hold Meta, which we find is by far the best value out of those ones. And for example, something that it's obviously been the poster child for AI and shot the lights out is Nvidia. We've not held Nvidia, and we've managed to perform quite decently without that. And I think the reason for that is, Nvidia has grown into its multiple fantastically, but it was expensive at the start, where we prefer to find positions that, they were trough earnings at trough multiples, not necessarily part of if it turns out to be a tech bubble. So something like Rolls-Royce, something like Abercrombie and Fitch, which have both done 500% over the last year and a half. So I mean, we've tried to find value in other places where we can take some of the risks of, an Nvidia away, if those risks turn out to be true.
Okay, before we get into your kind of offshore versus local tilt, question I was speaking to one of your colleagues, Novo Nordisk is a big holding of yours, currently on a P, I think, of 35.
Yes.
How does that fit within your framework of buying something that's hot? Because everybody loves that stock right
Everybody
now.
does love that stock. So Novo Nordisk, probably the one almost exception. It is, I think, the most expensive stock in our top 10, definitely. The portfolio currently has a PE of about 15 and Nova's at 37. It's a clear divergence there. And I also think it's not late into the Nova story. I think could potentially be still quite early. But also, like we said earlier, we've got some additional risk measures in place at the moment that we've introduced where we feel much more comfortable to potentially hold a position like that.
So let's go back to the comment you made about sort of letting your winners run. At what point does that stock become just too expensive? Because we're at a P of 70, P of 100, because it's a complete game changer from a food perspective and
Yes.
how we look at our diets.
Yes.
And I believe they're about to introduce a pill version from,
Yes,
from
they
an
are.
injection. That's enormous difference.
Yes, so injection obviously not very practical, and people don't like injections. So the pill could be a complete game changer. But in terms of your question, when does something become too expensive? I think you've got to play what you see in front of you on the field. I mean, so Abercrombie would actually be a good example of that. We've recently trimmed Abercrombie, although it's done very well for us. We've trimmed it just before earnings because it had run so hard and done so well that even after results came out, they beat on revenue, beat on earnings, beat on guidance on both of those, and the stock still fell about 5% or something. So at some stage,
The whisper number wasn't good enough.
maybe something like that. At some stage, I mean, that's a difficult question. We take it on a case-by-case basis.
Well, I guess if the earnings are good enough, but the valuation kind of stays where it is.
It will stay where it is
Okay, but
until that
what's-
story fades away.
I think the most interesting thing about your fund at the moment is you've got so little SA exposure, and yet almost every fund manager I speak to in South Africa who runs local equities or local bonds tell you how incredibly cheap their asset class is. You have like 5% now in SA.
Currently about 5%, yeah.
So
Just
talk me
below
through
5%. So it used to be a bit more. We recently sold out of an equity position, and we're trimming our bond position as well. We just find that in South Africa at the moment, there really is quite a lot of risk, and there's an absence of growth. So two things stand out, one being Eskom. Eskom, could potentially fix it. Well, it's not going to fix itself, but through the public sector and mainly the private sector, it could get better. That would be a massive growth driver. But then the other thing, which is a very fluid and difficult situation at the moment, is the elections coming up. And I mean, that is really, really unpredictable. So 3 months ago, you had a situation where there was no MK party. In the latest polls, they're, I think, number 3 in the country. In the short term, look, the rand could strengthen a bit, but long term, we struggle to see this as a positive development locally. So there's that. And then on the other side, even though SA equities, for example, they are cheap at the moment. I mean, there's no denying that. But you've got some other emerging market equities which are also cheap. So Brazil, for example, got lower inflation or pretty much on par with South Africa, high interest rates, so you've got more room to stimulate the economy. You've already got faster growth than you have in South Africa, and the equities are also cheap. So we just find, there's better opportunities out there or better risk-adjusted opportunities, and we prefer to go for those.
Okay, that's the equity side. But the bond side, I mean, we've got very high real rates here in SA, and yet you still don't want to be invested. I mean, just talk me through that. Do you prefer Brazilian bonds? Is that what you're saying?
No, we don't prefer Brazilian bonds. I think a lot of it stems from a currency perspective. I mean, it's difficult to call any currency in the short term, but in the long term, we have a fairly good idea of where we think the rand's going. Depending on how the election plays out, I mean, this could be an absolute disaster. Hopefully not. But if it is, then we'd rather be prepared for that.
Fair enough. And just a last comment on your fund. What sort of time frame should someone bear in mind when investing in the Worldwide Flexible Fund?
I'd say a time frame probably 3 to 5 years plus.
Well, welcome aboard to Flagship. And I think, well, you've been there since 2021, but welcome to the Worldwide Flexible Fund. And thanks for your time today.
Thank you, Joanne.